Welcome to CashOps, where we decode the financial giants and unearth strategies that could shape your investing future. Today, we're zeroing in on a name synonymous with success, Warren Buffett. Known for his sage investment choices and an enviable track record, Buffett's current financial moves are painting a picture we can't ignore. He's amassing a colossal cash pile, his largest ever at $150 billion. But what does this signal for the stock market and investors like you? Warren Buffett, the Oracle of Omaha, is a figure whose investment decisions have always merited global attention. His company, Berkshire Hathaway, has shown a phenomenal annual return of 19.8% since 1965. To put that in perspective, every dollar invested with Buffett in 1965 would be worth about $42,000 today. Despite such success, Buffett remains an enigma, largely eschewing macroeconomic indicators in favor of simpler, more timeless investment principles. His strategy is straightforward but profound. Buffett believes that the more expensive stocks are, the higher they've risen, and thus, the riskier they become. Conversely, the cheaper the stocks, the less risk they carry, offering higher potential returns. This philosophy might seem overly simplistic, but it has consistently proven effective, reflecting in long-term market trends. Let's visualize this with a historical lens. Over the past century, the S&P 500's performance has fluctuated dramatically, from gains as high as 300% over a decade to declines as steep as 30% during the same period. Key market downturns, like the Great Depression and the 2008 financial crisis, were preceded by high market valuations. Conversely, the most lucrative returns followed periods of lower valuations. This correlation is highlighted by the Shiller P/E ratio, a tool devised by Nobel Prize-winning economist which shifts forward by 10 years to predict market performance. Peaks in valuations have often signaled impending low returns, and the lowest valuations indicated upcoming high returns. By adhering to this valuation chart, Buffett has successfully navigated through turbulent markets, avoiding significant losses and capitalizing on opportunities. Today, Buffett's strategy of increasing his cash reserves and reducing stock holdings points to one thing. He perceives the market as overvalued, suggesting that returns on long-term investments might be minimal in the coming years. This scenario brings us to a crucial juncture as investors. When the market appears overpriced, how should we respond? If you're enjoying this analysis, don't forget to hit that subscribe button. We're here to equip you with strategies that can help you navigate complex market conditions, just like Buffett. As we delve deeper, it's important to recognize moments of anomaly, such as the late 1990s, when despite high valuations suggesting a downturn, the market surged for 2 more years. These exceptions highlight the unpredictability inherent in investing, underscoring the necessity for robust risk management. For long-term investors, akin to Buffett, the current market conditions suggest a conservative approach. Historical data, when juxtaposed against today's figures, reveals a striking insight. The dividend yield on the S&P 500 is notably lower than the yields obtainable from cash holdings. This differential hasn't been this pronounced since 1999, a year notable for its market peak. Buffett's strategy, rooted in the lessons from The Intelligent Investor, suggests that today's investors should consider a significant cash allocation, around 75% of one's portfolio, to secure stable yields, with only 25% invested in stocks. This conservative allocation is designed to safeguard against the low returns potentially offered by an overpriced market. So what can you, as an investor, take away from Buffett's approach during these times? It's about being prepared, staying informed, and knowing when to hold back and when to dive in. The market will always offer opportunities, and with the right strategies, you'll be ready to capitalize on them. As we explore Warren Buffett's investment strategy further, it's crucial to understand not just his moves, but the underlying philosophy that drives them. Buffett's method, distilled from decades of unparalleled success, is grounded in a deep understanding of market psychology and a disciplined approach to valuation. Let's dive deeper into Buffett's mindset. He operates on a fundamental belief that the market is cyclical. His historical moves suggest a pattern. He accumulates cash when the market is high and deploys it when assets are undervalued. This cycle of cautious accumulation and strategic deployment underpins his financial philosophy. Why is this significant for individual investors? Because it underscores the importance of patience and discipline in investing, a lesson that is invaluable in today's fast-paced market environment. Furthermore, Buffett's investment decisions are a testament to his adherence to Benjamin Graham's principles, especially those outlined in The Intelligent Investor. Graham's advocacy for the margin of safety or purchasing securities at prices significantly below their intrinsic value resonates strongly in Buffett's strategy. This approach not only guards against significant losses, but also maximizes potential returns. Now, let's apply these timeless principles to current market scenarios. Considering the volatility and the inflationary pressures we see today, how should an individual investor act? Following Buffett's lead, it would be prudent to adopt a more conservative investment posture. This doesn't mean avoiding the stock market entirely, but rather being selective, focusing on companies with strong fundamentals, low debt, and sustainable competitive advantages, attributes that Buffett has always prized in his selections. Moreover, Buffett's current cash-heavy position might also reflect his expectations of future market corrections. With high valuations and economic uncertainties, a significant correction could provide opportunities to buy premium stocks at discounted prices. This strategy of waiting for the right opportunity is akin to a hunter lying in wait for the perfect shot. It's all about timing and precision. Let's also discuss the psychological aspect of investing, something Buffett has mastered. The fear and greed cycle in the market often leads to poor decision-making. Buffett's approach teaches us to remain counter-cyclical, to be fearful when others are greedy and greedy when others are fearful. This mindset is crucial, especially when navigating a market that is prone to overreaction, both on the upside and the downside. Expanding on this, the psychological comfort of holding cash should not be underestimated. In a high market, the security that comes from having a substantial cash reserve allows investors to remain calm and collected, even as market dynamics shift rapidly. This tranquility is a strategic advantage. It keeps one from making hasty decisions driven by market hysteria. As we consider the broader implications of Buffett's strategies, it's also worth exploring how these can be adapted for the average investor. Not everyone has the resources of Berkshire Hathaway, but the principles of value investing, understanding market cycles, and maintaining discipline are universally applicable. Finally, let's look ahead. While Buffett prepares for future uncertainties by bolstering his cash reserves, individual investors should also consider their risk tolerance and investment horizon. Diversification across asset classes, considering alternative investments, and continuously educating oneself about financial markets are steps that can help mitigate risks and enhance potential returns. As we wrap up today's discussion, remember, investing is not just about striking when the iron is hot. It's also about knowing when to pass on the heat. If you found today's insights valuable, give us a like, and don't forget to subscribe to CashOps for more analysis and tips that help you stay ahead in the game of investments. Thank you for watching, and remember, invest wisely and stay informed.